Good morning. It's Vijay here. Today is Wednesday, 11th of December. Welcome to yet another episode of Pre-Market Commentary. Today I found some very interesting points which I will talk in the second part of the session. So let's just look at what happened yesterday. And yesterday was markets were climbing a wall of worry virtually. Because you see, there was constant selling by the warriors, a better description of the bears. And in the last half an hour, the markets took off. Now, the interesting point which I want to talk about is not about the indices, the mainline indices, but the broader market. So, first, let's get into the statistics. Please note that I am not a SEBI registered advisor. So, whatever I talk here is my own analysis and my own understanding of the markets. So, please take care before you dive into any of the stocks or sectors which I mentioned. Okay. So what are the cues we have this morning? Yesterday, Nifty closed flat. That was a remarkable recovery from the lows. It was like an exciting goalless drop. The Nifty and mid cap and small cap advanced for the 13th session. People think 13th is 13 is unlucky, but for people who are in Nifty, mid cap and small cap, had a wonderfully lucky 13 sessions. Just imagine where are we on Nifty and where are we on the broader market. Realty hit a 2 month high. Raymond and Phoenix Mills were the major gainers. PSU Bank was up 0.5%. PNB took off because some of Mehul Choksi's monies are going to come back into PNB, is what the news item was. Nifty IT continues to hit record high. LTI Mindtree was the leader yesterday with emphasis. Nifty Bank again snapped a two-session losing streak. Nifty Bank was the stronger of the two. This is what I've been talking about. Nifty Bank will lead Nifty higher. It is not the other way around. Most people are concentrating on the wrong index, which is the Nifty. I think one should concentrate on the broader markets, broader indices, and then in the large index, it should be the Bank Nifty. So it was Punjab National Bank and AU Bank did well. AU Bank is what both of them we hold. I am very bullish on AU Bank. Incidentally, AU Bank is one of those rare banks which is trading at February 2020 levels. That is pre-COVID levels. And I don't see any problem there. The results are good. FIs have increased their stake there. And hence we have bought into AU Bank apart from PNB, which is also having similar characteristics, excepting it is not near the pre-COVID levels. Nifty metals went up because of the China factor. We don't know whether China factor will really lead metals, but nevertheless, the sentiment is very strong there. Energy went down because mainly because of the Adani groups. They both dragged it, and then U.S. markets closed in the red ahead of key inflation data, which is today. CPI is expected to come in as per market expectations, and next week is the time when the Fed is supposed to reduce interest rates. There is already an 85% chance of them reducing interest rates as far as the US interest rate futures are concerned. Nasdaq also declined. In fact, both of them were in the positive. They came back into negative, bounced back a little bit off the lows, but still Nasdaq and Dow Jones came down. So was the S&P. Then the Treasury yield slightly edged up to 4.23. Treasury yield is the 10-year Treasury yield is operating in a band of 4.15 to 4.35. The 2-year Treasury yield rose about 2 basis points. Nothing great. Bitcoin, after reaching 1.01 lakh, is now slowly drifting down to around 96,000. Ethereum is, of course, not very relevant. Yesterday, interesting data came, which was the monthly data of the mutual fund. Equity inflow was about 36,000 crores vis-a-vis 42,000 crores last month. October had 42,000 crores. Yet October was a very bad month, and November was reasonably okay in the last 10 days, but November 2 was a bad month. November, the equity inflow came down. Now, at the outset, one would say that the equity inflows are ebbing, but when you look into the data a little deeper, then you realize why it is so. So large cap in our fund inflow came down because I think people are moving into small cap, which you can see 4,100 crores of the 3,770 crores, and mid cap went up by about 200 crores at 4,883. So where was the issue? The issue, of course, the ELSS fund inflow came in higher at 618 crores vis-a-vis 362 crores. Look at the sectoral thematic funds inflow. See, whenever any mutual fund comes with a sector or thematic NFO, invariably the monies flow into that. In October, it was very huge at 12,278 crores. In November, there were not many great sectoral NFOs. Therefore, you got a 5,000 crore less at 7,600 crores. ETF inflow again, if when mutual funds come with a new NFOs or new ETFs, again funds go there. You see there is a 13,000 crores came in October and 1,500 crores. So nearly about 12,000 crores drop in the ETF inflow, primarily because there were no new fund offers. The credit risk fund outflow is not very relevant, but what I'm trying to say is the regular fund inflows, about 35,000 crores, are damn good. People have not given up. If you look at SIPs, SIPs remain almost the same, 25,320 crores versus 25,323 crores. Now, let's look at what FIs and DIs did. Strangely, both of them bought about close to 1,900 crores was bought by the institutions. Now, the question people are asking is who are the guys who sold them 19,000 crores? Biocon, for instance, gave away 600 and odd crores of Syngene, so that must have been bought by the institutions. Plus, there are lots of PMSs and mutual funds who are extremely bearish on the market. I've heard of PMSs who are talking of anywhere between 30% to 80% in cash. I don't understand why we should give money to such PMSs who are holding money in cash. They can as well return the money. And they're also telling us that there are no investable ideas, which I find it very strange because I'm able to find at least 15 investable ideas every day if it is necessary. Of course, I'm not a PMS guy, so probably it's going to the money is going to the wrong hands. Same thing with the mutual funds. The big mutual funds are all holding. My mutual fund, which I like, is holding about 18,000 crores in cash. I don't know why they are not putting money there. So that is as far as the mutual funds are concerned. And now I just like to share with you something very interesting which I thought was here. So if you look at this, so this is the Nifty index. If you look at Nifty index, if you take it on a let's say on a 5-minute chart, you see this through the day yesterday, it was continuously coming down, and in the last half an hour, it just took off. Now, if you take Bank Nifty was also down through the day. This is 10th October, so 10 December. So it came down, but then it closed higher than the morning high, whereas Nifty did not do that. See, Nifty did not go above the morning high. So that is as far as Bank Nifty is concerned. Then if you go to other indices, so if you look at other indices, let's look at Nifty Junior, for instance. Nifty Junior closed near the highs. And if you look at it on a daily basis, that's very interesting. See, Nifty Junior is slowly and steadily going up. That is what we call the next Nifty. And then you have the CNX 500 also quite strong. See, mid cap. Mid cap is steadily going up from what we saw November 15th lows. It has gone up from 53,267 to around 59,000. Now, the fun part. See the small cap. Now, small cap has hit an all-time high yesterday. And see the way it has grown. Then, micro cap. This is again hit an all-time high yesterday. So what does this mean? This means that the smart money is not in the Nifty and Bank Nifty. The smart money is going into specific stocks. And there are a number of stocks which even today, are looking very interesting. So I think when the talking heads come on TV and on social media and talk of Nifty being expensive, first of all, as far as PE ratios are concerned, it is not expensive at around 22 plus. 28 plus is what I would call expensive because that is when the markets peak out. Bank Nifty is at 14.5 PE, which is one of the lowest in last 10 years. I don't know why the so-called knowledgeable people who manage lakhs of crores of investor money are looking at the wrong place. The smart money is looking at the right place, which is the mid caps, small caps, micro caps. Of course, the major mutual funds may not be able to put too much money there because they could move the prices exponentially. But they also have mid cap funds, small cap funds, and they manage that, and they come on TV and they come on social media and they conduct spaces, and all of them are in unison that markets are expensive. If you look at purely parameters of where we are in terms of P ratio, earnings, growth, all that, markets by and large are not even fully priced. They are moderately underpriced. There are still bargains. Now, when you put money in a mutual fund or a PMS, I think it is better for you to find out what is the track record in the last 3 to 6 months rather than what is the track record, last 2 years or 3 years, because everybody has made money in the last 2 3 years as far as the mutual funds are concerned. But if you look at the last 3 to 6 months, you will see a lot of underperformance. If you look under the numbers, like what I did for the mutual fund inflows, we found out that the NFOs and in the ETFs took away all the money in November and left nothing in October and left nothing in November. So just looking at headline numbers don't make sense. You have to dig deep. And for that, if you are onto my Telegram group, I do talk about stocks all the time, but I'm not recommending anything because I'm not a SEBI registered advisor. And we continue to be bullish. We will look for bargains and we will add up. And I do mention as to what we are buying. Of course, I can't be buying the entire set of bargains, but a few bargains here and there. All we need is 10 stocks per year for us to make a reasonably good amount of money and beat the index. So whatever you do today, I hope it is successful. Thank you for joining.